Hello traders, this is my weekend video, and the theme for this weekend is the high yield squeeze. And basically what we saw Friday was a major squeeze in high yield sensitive sectors that pushed the markets extremely higher off the news of the jobs report and the more dovish tone coming out of Chairman Powell of the Fed. Okay? And that's what I'm going to start with. Now, you see, we're still in a well-established downtrend on high yields, and we just got a responsive bounce on our high yield bonds. We are not out of trouble yet, but it is constructive that we're doing this. And if you go over here on my volume profile on HIG, well, no, that's the wrong one. It's EWG, HYG. Okay. What I would like to see in high yield bonds is well, that's a monthly profile. See how the monthly is so elongated? This is not a really healthy bounce scenario for high yield bonds when you have such an elongated monthly pattern. And if you go down on your weekly chart, okay, and for the week, because of the information we saw on Friday from the jobs and Chairman Powell, we did get a bounce up above our high yield or our weekly value area for our high yield bonds, and we closed on a buy signal for the high yields, and we put a uppercase P formation. Okay, this is typically buyers are not done at these price points, in my opinion. It's a continuation pattern. And if you go down on your daily thing, you can see that we put value in at the top of the range. There was rejection at the highs, but we are right up there within a few cents of those highs, suggesting that the auction may not be completely over at this rally, the rally to the upside. So this is, in my opinion, going into Monday is the most important situation we need to keep on our radar, because this is going to give us a pretty good indication of what's going on in the markets. If you look for the last 83.33, that was a high volume point of control area. Responsive possible sell zone, or the 83, well, right around the $83 area. And if you notice, we're not even there yet. So I'm thinking we're going to at least come up and test the $83 area. We do have a low volume point of control right here, and I've got this on my daily, I think. And that acted as resistance there Friday. There's basically a volume void that we gapped down, passed through, and we closed right up there near that gap down. We tried to push out above it. So this is something to really watch right here, that we really have a very low volume point of control that the high yield bonds need to break through, which as of Friday, it looks like the high yield bonds do want to continue higher, in my opinion. So the monthly value point of control, if we're rejecting these lows on the high yield bonds, it would make sense that we'd be coming back to the $83 level on this time frame too. So this is very important for continuation in the markets, in my opinion, probably the most important thing. And like I had mentioned in prior videos, that finally Powell came out and gave statements that they're willing to slow down the reduction of the balance sheet. And to me, that is a very bullish signal to the markets. It's a relief to the markets knowing that we can get this quantitative easing, maybe put it on hold for a while, and to allow all this. $1 trillion of bonds, corporate bonds, are coming due this year. And reducing the balance sheet in face of that is ridiculous. I mean, we need to keep these high yield bonds way up here at the lowest yields possible going into all of these auctions that are going to be hitting the market this year. Because until, unless we get the high yield bonds back up in this area, there's going to be a lot of businesses going out of business. Okay. One of the strongest areas I saw hitting the tape, you see this low volume point of control? We blasted through it today, or Friday, on the IWM. And this was largely due to the high yield bonds, in my opinion. The high yield bonds are what has devastated the Russell, because most of these companies have to get their money, get their financing from the high yield markets. And there is a mass liquidity issue in the high yield. And the fact that we gapped up above this is a bullish signal for the markets if the yields do continue higher. That's why I said Monday. That's the most important thing to be watching, in my opinion, is the high yields and how they're. See if we see continued buying in the high yield markets. This Thursday, we did see a massive put spread. Somebody was buying a massive put spread in high yields Thursday, and they pretty well took a bath there Friday. So just keep that in mind. They were betting on Powell not saying a word about the balance sheet, which he did. So that might be a contrarian indicator that the lows are in for our high yield bonds. Okay, we had a healthcare conference Friday, and it was extremely bullish for the biotechs. And I think this massive rally in the biotechs had a lot more to do with the fact that the high yield bonds were catching a substantial bid there Friday. And it was the three main areas are the biotechs, the energy stocks, and I can't think of the other one off the top of my head. Well, those two areas are the ones that are majorly impacted by the high yield bonds. Yeah, because those companies, a lot of them don't make money, and they have to get their money from the high yield sector. And so we saw a massive short squeeze happen in our biotechs there Friday, and that was a major driving force for the markets. Just keep that in mind. Exactly what happened. I think it had far more to do with the high yield pop than it had to do, and the short squeeze. And we did have above average volume too. So that's why it's so important to keep a very close eye on your high yield bonds. Now, looking at this, close this real quick here. Looking at this correlative chart of the SPY versus the TLT, the 10-year bonds, we had a relative underperformance of the 10-year bonds because is a risk on atmosphere Friday. And this is a trend which could very well continue. This is a basically if people are coming in buying up the markets at these valuations here, then the TLT is going to continue to underperform the S&P. So just keep that in mind as a potential scenario that seems to be playing out here. This is a correlative chart, so this might be a theme that's developing here in the markets. Okay, on the bearish side, what was going on Friday, you saw a huge, a lot of people were still buying out of the money puts off of the rally. They are not trusting this bounce. I mean, there are still a whole lot of bears out there, and we're putting in new lows on our skew. So that suggests that this relief rally was just a buying opportunity for the bears to add to more short put positions going into this week. So this is we are hitting substantial lows here on our skew. Despite the fact that they're still willing to continue to add puts at these valuations down here. And basically, what I want to show you guys here on our daily, you see what's happening here. Our VIVX, our volatility index of our VIX, we have actually, our volatility is starting to increase. The volatility on the VIX is starting to increase on these massive moves to the up and down on the markets. This is not saying the market. This is not saying that the markets are, as this goes up, the markets are selling off or anything like that. It's saying the volatility on the VIX is starting to really pick up here, suggesting a major move is imminent in the markets. So, and seeing as them buying more put protection here, I think they're buying the more put protection because of the volatility on the VIX continues to increase as the markets catch a little bit of a bid. So, a lot of people not trusting this rally one bit. Then I want to talk about the historical volatility of the markets. As of Friday, our historical volatility started increasing. And historical volatility, that's the backbone of your volatility. And this is not a very healthy sign to see our historical volatility increasing when the markets were supposedly catching a nice massive bid there Friday. So that suggests that we are possibly getting a false signal in that rally as of Friday. So just keep that in mind. We are at year highs on historical volatility on our markets. So this is a contrarian bearish indicator. So keep that in mind. We are at extreme highs on volatility, and it looks like we are going to even go higher. And long-term investors do not like seeing the historical volatility going up. They want the volatility coming in for longer-term positions. As historical volatility goes up, they just do short-dated positions. So just keep that in mind as a general rule. Our our yield curve, we did manage to cross out of inversion just by a smidgen from the 2-year went slightly below the 5-year. And we did catch this bid off the jobs report, suggesting going into the jobs report, they were starting to price in a 0% interest rate hike into the jobs numbers. And then once those massive job numbers came in, now they're starting to price in 1, possibly even a 2 rate hike scenario going into the end of the year. So it was reasonable after such a massive jobs report to see a spike in the interest rates. Okay. And if you look at your 2-year, 4.6% short squeeze, and this was the safety trade for our 2-year. People were rolling in the 2 and 5-year as a safety trade for the markets, and we did catch a nice little bid, 4.6% in the 2-year, and then even bigger in the 5-year. But then after that, the yield curve started collapsing, and yes, we got an uptick, only half as much in the longer dated securities. So that's a flattening of the yield curve, and that's negative for the primary banking sector to see stuff like that happening. You want to see the longer end of the curve outperforming on a daily basis versus the shorter end of the curve. And we didn't see that. So that suggests an underperformance in the financials from here on out. And if you don't have the financials driving the markets, that further exemplifies the relative weakness setting up in the markets despite this massive rally as of Friday. What we saw Friday on my comparisons charts, a relative outperformance of the Qs. Okay. And so whenever I see something like this, then I want to delve into what actually was going on with the Qs to suggest this. Okay. And what I did, I looked at FDN, that's your primary internet stocks, versus the Qs. And what we saw was a major outperformance of your internet stocks versus the Qs. And that was the driving force of the NASDAQ, was your very few 4 or 5 stocks that were really driving the Qs. So that does suggest that the breadth was not supportive of this move higher, knowing that the internet stocks make up such a smaller segment of the Qs. So keep that in mind. And then if on the flip side, if you look at your SMH, which is the primary breadth for your NASDAQ, look at this. Your semiconductors were underperforming the NASDAQ. So this right here tells you that your breadth on the move higher was not supported by the big move in the FANG, and suggests that the FANG move was a one-off and that you could probably come in Monday morning and short the FANG, uh, do relatively well, in my opinion. So just keep that in mind as a potential scenario for tomorrow. And then if you go on the flip side on your XLI versus your SPY, because that's your industrials or the backbone of your S&Ps, and basically we had a little bit of a relative outperformance, because it's green. Friday we had a little bit relative outperformance of our industrials on our versus our SPY. But then if you delve down, your IYT versus your industrials, your transports, okay, we still got a little bit of a relative outperformance of your transports versus your industrials. So basically, that tells you that of your industrials, the backbone, which is your transports, they were catching a relative bid. And if you want to compare it to the IYT versus SPY, that's the final comparison you want to look. We had even more relative strength on our transports versus our SPY. That suggests the jobs number were so strong that the markets are anticipating very good industrial results uh, going into earnings season because the jobs numbers were so relatively strong. So just keep this in mind that shorting your industrials from here, you got to be a little bit careful because of the relative strengths, in my opinion, on the industrial side. And so that's just what I'm getting from the charts, and we'll see what happens on that. Okay, another critical comparison you want to be considering in the markets here. We had a relative outperformance in the U.S. oil versus the SPY. U.S. oil was catching a little bit better bid versus the SPY there Friday. Okay, does that mean a continuation? I have no idea, but I just wanted to point out, because the jobs number were so strong and everything, that there was a responsive bid in the oils patch as of Friday. Now, in the same tone of breath, if you look at your XLE versus your SPY, it had a close into it. It closed weaker into the day, but it was still had a relative outperform versus the S&Ps on your XLE. And I think a lot of the XLE outperformance had to do with the high yield bonds, because so many of them are tied to that high yield. So this could be a contrarian indicator that this is not going to hold, that there's going to start being some relative weakness here. Then on the flip side, if you look at your Dixie, this is your dollar index. And if Chairman Powell's speech is telling us anything, that they're going to be more accommodative between the balance sheet and the interest rates, depending on the data flow coming in, that this primary uptrend line, which has been basing for some time now, it looks like we are setting up for a relative weakness period in the Dixie, in my opinion, if this is the case. And that should be a excuse me, bullish scenario for the crude oil space in the short term. So yeah, we're getting a little conflicting things happening here. So just keep that in mind, that this scenario looks like it's happening because we are at an extreme read already in the Dixie, and potential for lower interest rates or stuff like that, then that would be relative weakness. But so far, the data coming out does not overly support a weaker Dixie. That industrial data that came out, is it Thursday? That was really bad, and that's forward-looking industrial data. So, just want to keep this in mind here for the week, we had an inside week on the Dixie, and it's right smack dab in the middle. So just keep in mind on this. We were getting conflicting signals. One on one side, they were uh, taking up the transports, and after having a horrible industrial read there Thursday, so quite conflicting the information they were giving us there in the markets. We had pretty much a doji on the weekly on our XLP versus our SPY. Undecisive which way it wants to go. Another run back up or a potential run back down. Based on our VIX scenario, it looks like, to my opinion, that the VIX staples will run back up based off of what the VIX was telling us uh, and the skew, in my opinion. And then you had your XLU. It was a risk on trade Friday. Your XLU versus SPY, it's in this higher distribution zone. And if the risk off scenario does continue to unfold here, then that's going to catch another responsive bid, and this is a buying opportunity to the upside. And keep in mind, if this is the later stages of a market cycle, then you're going to see a sustained bid in your consumer staples, your healthcare, and your utilities. So just keep that in mind that we are by no means out of the woods in these markets. I'm going to finish off my major indices here, and we are at a low volume area that the SPY closed at this lower volume distribution area. And like I said, they were buying a lot of put protection here, thinking that that prices could not push up any higher away from where we're at right here. And the most logical place to do business would be the 249.60 area. That's the highest volume point of control for the monthly basis. So, if this was just a one-off short squeeze, coming back down is very easily could happen here, because it takes a lot of short covering to start pushing back up into the next distribution zone. So, and they were actually adding put protection. So something there just doesn't make sense to me. You either squeeze hard. Why are they buying puts if they're expecting a squeeze hard? So that's just my opinion. And then on your Qs, okay, we actually closed right here on a low volume node on our monthly. Okay, so this is a responsive topping formation on our Qs. So keep that in mind. That's why they probably bought some put protection going into the weekend, realizing that this is a responsive sell zone for the markets, and the accepted price to do business for the month is 153.20, and this is still way early in the month. Okay, so and I forgot to give you XRT SPY. One of the areas that's outperforming, that's your retail sector versus SPY. They're expecting a really good solid Christmas season. And you see what happened here? The retail sector come Friday, it underperformed the SPY. Okay. And that's what that candle tells us right there. And that gives me a little concern here. I said, if you got relative underperformance in the retail sector, which has been relatively strong, on a very strong up day, does that mean that the driving force behind the retail sector, Amazon, can continue to charge higher at these resistance highs? It has found resistance here in the past. So, yeah, a lot of reason to think that the Fangs are not in a very good health, in my opinion, despite the fact that they were outperforming Friday. Okay, so like Netflix, I think Netflix is one of the best shorts for this year, 2019. So I'll just finish with that. I mean, I think Netflix is so overvalued; it's ridiculous. And all this new competition coming in is just going to be devastating. And you look at candles like this and you think, oh, it's going back up to the moon. Well, I am one person not in that camp. It is right here at a resistance zone, in my opinion. Look at the volume profile on Netflix, and it just doesn't make one bit of sense to me why it continues to go higher. That is a responsive on the daily here. This is a responsive resistance area, and if you go on your 15-minute value, actually was accepted right here at the high end of the range. So we'll see what happens Monday. This is a continuation pattern for Netflix. It defies logic to me why this thing continues to catch a bid at the high valuations it's at. Okay, that's all I got to say here. If you haven't noticed one thing, I am bearish to markets, but I'm seeing so many conflicting things here. It's hard for me to sit here. I am net short going into Monday. I do have a couple long trades on as a hedge, so I don't get hit too bad if things do decide to gap up. So good luck, and hopefully we can all make some money together.